Good day. This is Arlan Suderman, Chief Commodities Economist at StoneX, and welcome to our webinar. And I want to start off by apologizing for the technical problems we had last month, and thank you for your patience. What we learned later was that we had problems with the internet coming into our building being disrupted. That was creating the problems that didn't allow us to finish our live webinar. But at least we were able to send it out to you in an on-demand format, albeit delayed because then it has to go through compliance when it's not live. But thank you for your patience on that. We're glad you're back, and hopefully we'll get through this without any problems with our internet service. But we have a lot to talk about, so let me put this up here. I should have had this up here while I was given that little explanation, but want to be sure you get the opportunity to look at our disclaimer. And then we're going to move on because price is still a function of supply and demand as modified by the flow of money. And we've got a lot to talk about in that arena today. First of all, the latest CPI data, that's Consumer Price Index data, that is the more followed by the public and the markets inflation data. And it came out on Thursday, which indicated that we saw a 0.2 of an increase, month-on-month increase in the headline CPI. And for the year-on-year, it was up 3.2%. And you'll find those numbers right up here. And that was matched or was better than trade expectations on Wall Street. And I want to break down the details here and talk a little bit about this. First of all, how did they get that number? Well, a couple of keys is gasoline only went up 0.2% in July. Now, we know that the board, on the board of trade, or not board trade, but on the NYMEX, gasoline prices went up a lot more than 0.2% in July. What this says to me is it was slow making it to the consumer level, that price increase relative to when the data was collected. Now, if we look at fuel oil, it saw a 3% month-on-month increase, but both of these remain at about 20% plus down for the year-on-year. And so year-on-year numbers remain very tame. Month-on-month numbers, I think we're going to see that gasoline really go higher next month when they report on the August data. Electricity was down on the month. Electricity costs, and I think that's while we saw a lot of headlines about extreme heat during July. What they don't tell you is population-weighted temperatures were basically down. The heat was pretty much pushed to the south in a lot of our population centers and crop growing regions for that matter, saw some below normal temperatures. And I'll talk a little bit more about that coming up, reducing electricity costs during the month of July. Now, if we look at services, less energy, really hanging in there, 0.4% month on month, 6.1% year on year, very heavily labor intensive. Wage inflation remains a problem. When you look at transportation services, up 0.4%, on the month, 7.7% year on year. Therein lies some of the remaining problems. So if you take that, which these areas have been relatively constant, and then you start bringing in these higher energy prices, if this starts to escalate, then you start bringing in wage inflation, or not wage inflation, but you start bringing in that commodity inflation component back again. That is the risk. So what am I keeping my eye on? I'm keeping my eye on the same thing I've really been emphasizing for the last, I want to say 6 months plus, and that's the crude oil market. The crude oil market made a significant break above the 200-day moving average late last month. That is very significant to this market. And it said the downtrend was over for now. Doesn't mean it can't change and go lower again, but the current sentiment is no longer lower. It could be establishing a broad sideways trading range, or it could be establishing a new bull market. That's going to be determined to a great extent by the economy, the U.S. economy, the world economy, the Chinese economy. Those are going to be the factors. But it's not just about demand anymore. It's about supply, because Russia, which is a major influence in the OPEC plus cartel, needs high oil and gas prices to fund its war. Its currency is approaching 100 to the dollar right now, rubles to the dollar. That makes it easy to sell stuff, but expensive to buy stuff. It needs revenue, and it has a big influence on OPEC. And so they've been cutting back production. Saudi Arabia cutting back another million barrels per day this summer. Russia cutting back another 500,000 barrels per day. So supply is now a bigger concern than demand, and we're kind of turning that corner. Will food inflation join in? That's largely going to hinge on the war in Ukraine. I'll talk more about that in a little bit, but let's continue this story now. This is looking at Fed fund futures continuing to inch higher. Now, a couple of risks that really were significant here since we last talked. And both of these days, one in late July and then one here in early August, we had days in which the grain and oilseeds had bullish stories, generally related to the Black Sea, what was happening there. Days in which you would have expected grain and oilseeds to rally and maybe rally significantly, but instead they sold off hard with the rest of the commodity sector as well as the equities. Why? Because of news in the credit and the banking sector. And so the first in late July was Fitch downgrading U.S. government debt from a AAA rating to a AA plus rating. They focused on the patterns of spending, fiscal irresponsibility in Washington over the last 20 years that continue to compound. I'm going to spend a little time on that. Then we had a similar sell-off day here in early August, when Moody's downgraded 10 small and mid-sized banks while issuing a warning for 6 large banks. That tells us that the problem in the banking sector is not over, particularly if the Fed does need to go higher and longer, as we're continue to hear from the Fed. And I don't think anything in that report, CPI report, or latest job report, really saw the changes that the Fed has been emphasizing that they need to see in order to pivot interest rates. So while the market is saying no more rate increases this year, and in fact, when we get to probably March of next year, they'll start cutting rates. The market's been wrong for the last 18 months, and I believe they're still wrong based on what the Fed has told us. The market doesn't believe the Fed, but the Fed has been very consistent over that period of time. Now, this is a significant factor we need to continue to watch. And here's why. Look over here. We see on the left the national debt at $32.7 trillion. That's up $1.8 trillion over the last 2 months. It took us 209 years, I believe it was, to accumulate $1.7 trillion in debt. We've added that much to it in the last 2 months. That exceeds our gross domestic product of $27 trillion. So the interest on that debt is $657 billion. 650 billion. A year ago at this time, I believe it was about 375 billion, and it was on the rise. And it's continuing to rise as debt certificates are not paid off, but simply rolled at the new current interest rates. So that's going to keep going higher. Interest on that debt, I told you, $657 billion. Now, how much of that debt is owned by foreign investors? $7.6 trillion. Everyone says, oh, China owns all of our debt. No, they don't. It's a little less than 900 billion that they own, and that is down significantly from what it used to be. I remember when it was $1.4 trillion. So our debt has gone up. The portion that they own has gone down. So the percentage that they own now is what, less than 3%? So they don't have near the hold on us and as far as the debt that they own that you might think. Japan's the larger owner. I think they're like 1.1 trillion. Now that is a concern because their new central bank president, or whatever they call them there, is trying to unwind the quantitative easing program that his predecessor had going for so long. That's the program that Ben Bernanke copied back in 0809 that got us into all this trouble, and other central banks around the world copied him. And he's trying to unwind that. So Japan, which has had negative interest rates, is going to be moving positive, particularly in the longer term period. And a lot of that Japanese investment in U.S. debt is going to be rolling out, going back home to Japan. As that does that, and the government keeps on spending, requiring more and more debt certificates to be sold, in other words, a larger and larger supply of debt certificates, we have to increase the demand for those debt certificates to keep demand for debt certificates in balance with supply. But the Federal Reserve is shrinking its balance sheet, reducing what it buys by $1.14 trillion in debt certificates per year. Now Japan investors are expected to reduce what they buy as well. So how do you attract more buyers, more demand for debt certificates? By raising yields. So longer term, this argues for higher yields. Another one of those factors. Doesn't mean that yields have to go up, but it's one of the factors on the balance pushing for higher yields. That's a risk going forward that's going to impact the markets. When it costs more to store, it costs more to produce. It's part of the whole equation. Now, as we look longer term, 4 years from today, USDebtClock.org, I don't know anything about them other than I've been following them for years, and they seem to be a pretty steady numbers cruncher, I'll call them that. Beside it, you see the CBO projections and the OMB. CBO is Congress's budget office. OMB is the White House's budget office. Both of those have a partisan bias. USDebtClock.org says if we continue on the same path we are currently on, it doesn't project that we're going to change paths. It just projects if we're going to stay on the same path we're on, this is where we're going to be. $44.7 trillion debt 4 years from today. So that's August 11, 2027. The interest on that debt is projected to be 2.8 trillion. Can you comprehend 2.8 trillion? Well, that compares to what they expect that we will be paying on national defense of $913 billion. So they're projecting that our interest payments on our debt each year will be 3 times what we spend on defense today, and it will exceed the 2.3 trillion that we will be spending on Medicare and Medicaid, and the 1.8 trillion that we will be spending on Social Security. That's unsustainable. It's unsustainable. So what are the options? Massive tax increase that kills the economy, large spending cuts that have negative implications for the economy, but Congress, neither party of Congress has been able to push that through when they've been in control, or to monetize the debt, printing more money to pay our debt. Quantitative easing, I'm sorry, that's what it is. Likely some combination of the above. As we've seen, monetizing the debt is highly inflationary and can lead to the collapse of the dollar because we will have to do likely much more than we've done to this point. So that is a risk that Fitch was raising to our attention. Moody's has not yet done their credit downgrade. So that risk is there yet as well, and we could get additional downgrades from those three, the third one being the S&P. Watch for that. Now, as we look at the 2-year and the 10-year Treasury yields, you can see that they inverted here back a year and a half or so ago. They remain inverted. That has been a steady predictor, not a determiner, but a predictor of what the market thinks that we're heading into a recession. And then you see prime bank loan rates, and how they are rapidly escalating higher as a result. And you can see that we've been trending higher here recently with both Treasury yields, but particularly the 10-year is going up faster than what the 2-year is. And it's been at that discount, and now it's thinking higher for longer means maybe the 10-year needs to be higher. And the 10-year really popped when we got the Fitch downgrade on the national debt. And that means that home mortgage loan interest rates went up, consumer loan interest rates went up. So it costs us all, and it costs the economy when we get a downgrade. Now, our StoneX Commodity Index, which is the dark blue line, continuing to track with the 5-year break-even inflation rate. But look, it's taken a turn up. That's largely been because of energy prices, which to me is the canary in the coal mine. We've already got a question on that. So Len, thank you for that question. That's why I use the term. It's a very good term. It's the key indicator. I used that term last winter in presenting, and it's so true. The canary in the coal mine that we've got an inflation problem again on the commodity side is crude oil, in my opinion, and it has turned higher. Now we'll see, we're starting to see an upward turn in the 5-year break-even inflation rate. That's the rate that the market thinks that inflation will average over the next 5 years, and see if that continues higher. I'm not sure it will, but we'll see. And look at this. Now, let me go back. The correlation on this is 0.88. 0.88. That's very strong. Anything above 0.7 is considered statistically strong. So 0.88 is pretty good. And money flow in or out of the commodities tends to be a lagger. But yet, in this case, the commodities went up ahead of expectations. But the Fed funds, inflation rate tends to go up or go down after we see the move in the commodities. So we're seeing that here. We've been seeing that inflation rate, the headline number, popping up. It went down to 3%. Now it's back up to 3.2%. But look, our StoneX commodity tracker, our basket of commodities, had already been heading higher. How high will it go? Is this that break in trend that we've been expecting? Time will tell, but to me, this is a red flag. And the money that's been coming out of the commodities is starting to come back in. As the interest rates went up, money came out. Now it's starting to come back in. Now, this is part of the key that the banks are trying to, or that the market's trying to figure out, is we are seeing a big increase in tightening of credit standards for loans. Doesn't matter what kind of loans. Now, some loans are starting to back off again a little bit. We see on the right-hand side, that's easing things. But this is one way that the Fed can slow down the economy to bring down wage inflation without having to take interest rates higher. So we don't necessarily have to take interest rates higher, although my bias is that we will. But it does suggest that maybe they stay high longer. Let's talk about Ukraine. Several things here. First of all, this pink area is the area generally occupied by Russia. Odessa right here is where the 3 ports are that were part of the Black Sea Grain Initiative that Russia has pulled out of, and Russia has since, on a number of occasions, sent missiles in to attack that infrastructure. That caused Ukraine then to ship grain on down to this area along the Danube River. And my apologies to our listeners in Europe if I'm mispronouncing that. But it's these terminals on the river here that across from Romania where it's trying now to export. But Russia has also attacked them on a couple of different occasions. So that's a key. This week, we did see Ukraine open up new humanitarian corridors for ships that are trapped in this area, who have been trapped for the last year and a half, to be able to get out and to allow grain to flow. The question is, will Russia allow that to happen? And that's going to be the key. Now, let's talk about this a little bit. I mentioned how Russia has not been attacking ships per se, although some ships have been damaged in the attacks, but they have been attacking infrastructure. And then they said they will consider any ship moving toward Ukraine as possibly having military motives and therefore vulnerable to attack. Ukraine has turned it around and said the same thing then about ships moving toward Russia, including to their ports. Now, if you look at their ports, they have a number of ports in this area where a little over 40% of their grain comes from. But their largest exporter of wheat is right here. And the Novo port, by some data, some years, will have up to 57% of their wheat exports, in addition to 1.8 million barrels per day of crude oil exports. Excuse me. So Ukraine has made attack on that port. It hit a naval, because there's a naval base there too. It hit a Navy ship. So you've seriously damaged that Navy ship. It has also been attacking the Kerch Strait Bridge, which is right in there. That bridge is what Russia used to transport resources to support its military in Crimea and in southern Ukraine. So that's a critical link right now that they've been attacking. So ships only moving through that strait now, which is about 12 miles wide, only during the daytime, not at night. If we were to see the risks rise sufficiently to stop the flow of grain and oil out of Russia, then that would be considered a game changer. We're not there now, and I don't think we're close to being there now, but it could happen very quickly. Will it happen? I don't know, maybe not. But if it does happen, then that's a total game changer for this war and for the commodity markets as a whole. Now here you see monthly exports out of Ukraine. And notice that the red is water exports. That's what's been so critical. It's been a critical component. The green is what they've been putting through the Danube River, that avenue that I pointed out to you. So if Russia cuts both of those off, then you're left with 2 to 2.1, maybe a little bit more in the way of exports that they may be able to do over land. But that has a lot of obstacles as well. So that's something to keep your eyes on, what happens there. Month of July, they were still able to export quite a bit through the Danube River. Will that continue? That's the big question mark. Will Russia allow it to happen? Will shippers be confident to happen? The bottom line is the war is still continuing to escalate. And the more it escalates, the closer we get to the possibility of Russia grain and oil exports being curtailed. President Zelensky of Ukraine promises to match Russia's attacks on its ports, but Russian ports are now at risk. And so how well they handle this is going to be a key. Europe will find a way, in our opinion, to continue to facilitate grain exports over land to the West. We think that'll happen. It won't be easy. It'll be easier said than done, but we think they're going to search to find a way to do that. And as I said, it's a game changer if Russian exports are curtailed. Now, China's related to all this. Tensions with leadership continue to grow. Some of that's related to Taiwan, which is circled there. but it's related to a lot of different issues. Will that allow us to continue to move grain into Europe, which is the world's largest importer of commodities? The headline risk is quiet for now, but Europe and the US are both continuing to reduce imports from China. That's due to a combination of factors. Number one is decoupling from China, moving production home or to other countries so they're not as dependent on China. Item number two is going to be not just the decoupling, but the weak economic climate in the United States and in Europe. So consumers are buying less. So if you see what they're doing, the trade with Britain, with the Belt and Road, I'm saying, what is BNRI? The Belt and Road Initiative, which most of you have probably heard of, those countries who belong to the Belt and Road Initiative, trade with them is up 7.4% year on year. Russia, which is a part of that, it's up 51.8% year on year. But Taiwan is still an issue, and that increase to the BRIC nations hasn't been near enough to offset the decrease overall of trade because of the loss of trade with the United States and Europe. That just continues to grow. Now let's look at export demand. On the left, you have corn exports for the market, for the new marketing year. It starts September 1. Pre-sales, these would be. On the right, you have the same for soybeans. And you can see that we've certainly sold a lot more soybeans than we have corn for the new marketing year that starts September 1, but not near as much as we would expect in recent years. So that's a concern going forward. Obviously, we'd like those ships taken off from the United States and exporting U.S. commodities, and we'd like to be rewarded for that. But it's simply not happening yet at this point. We have seen a notable increase in China buying U.S. soybeans of late, but we're still way behind where we would expect to be. This graph here does show the recent shipments, the recent trade through through export channels. Okay, what's happening in the oceans? Because the ocean temperatures and how they vary really drive and are related and impact our atmospheric conditions. So one of the keys right now is this growth of El Nino, the warming of waters in the equatorial Pacific. That's been about the only constant. We would also look at other things like feedback of just upstream river feedstock of storm systems developing here and trailing across the United States. But if we look at history, when we have this setup, we tend to be very slow on the movement of storm systems across the United States that can deliver rainfall. And so that's something we're watching, but it also tends to give us that northwesterly flow that keeps us rather mild, and we are seeing that. It does tend to give us a subtropical jet that brings storms across like this. One of the problems to that is this cooler area of water here, but that water is being eroded to a great extent by the strength of the high pressure that we have up here in the warmer areas. Also, it's very warm water in the northern Atlantic is also a factor as well. This shows you where the major grain producing areas are of the Midwest, where the weather matters the most. Take a look at this map. This is July Corn Belt rainfall on the left. Actual rainfall, everywhere it's green, got at least 4 inches of rain in July or more. Notice the dry areas right in here that saw very limited rain. That's where subsoils are really hurting right now. If you use a weighted rainfall total, just a little bit below normal, as it shows here, not a significant problem. But USDA, because they're saying that they're going to be taking the data from farmers here in October on production and yield, right now they're hanging it up there, keeping it relatively high. Now, as we look at temperatures in July, well, it looks warm, doesn't it? These are average temperatures, not high temperatures. But when you compare it to normal, it's just a couple of really about one or 2 degrees below normal. And so that'll have an impact on how the soybeans feel and how the corn crop feels, very favorable for it. If you look at recent tendencies, we have to look at the fact that we're just below normal here on yield, and that does tend to favor a bigger kernel, a longer corn kernel, bigger soybean kernel. So, is that going to bump yields up more? Well, if there's no kernels there, it can't increase the size. If there is, then it can. So probably a little bit of both, but I am looking for some net gains from today's report. If we look at August rainfall for the first 10 days, extreme rains, topping 10 inches in this area here. But for the area as a whole, above normal temperature rainfall, above normal rainfall. But if we look at temperatures, it's a little bit below normal. So as we look at this overall, maybe not the ideal summer we'd like to see, but it sure is beneficial. I think our biggest concerns are going to be in this area. That's where our soil moisture levels are the tightest. Now, if I clear this, we did have some good storms go through in this area last night. That erodes it down a little bit, but that's an area we need to be watching. If we look at temperatures, again, a little bit below normal, but certainly that was pretty normal or above, really from the western part of the U.S. going to our north. That's a real problem and a concern. All right, next 2 weeks, we look at rainfall, all three models having a fairly active pattern here in the days ahead. It's probably going to be more the next 5 days or so, but then it changes. We're seeing more of this high pressure reach up here into the Midwest and dry things out up here. We see the same thing in the European model as well as in the American model, week 2 forecast that we see up here, drier. But we do see a more active pattern up here. And right now we're looking for that to continue. We'll see how that plays out. I think it's going to give us a touch of what we can expect from the Weather Service. But the Weather Service is not going to be painted in a picture, and it's going to anticipate a hotter, drier pattern as we get into the 3rd week of August. After that, it seems to start improving once again. So we just have to get crops through that week of the 21st when we see the Pro Farmer Crop Tour. So that's going to be big. Looks like good weather for the most part, maybe some rains up in the northern part of the belt. And if we look at today's data, let's talk fundamentals. Old crop wheat. These are old crop ending stocks. Wheat doesn't change because that was locked in by the June 1 quarterly stocks report. Corn, 1.457 is 1.437 is my estimate. USDA just 10 million bushels above that. I got to feel pretty good about that. If we look at total soybean production, 260 million metric tons. I was looking for 241. The trade was looking for 251. This is one of the oddities of the soybean market, and I would anticipate that we will see USDA come down on my number eventually, or I'll go up to their number. But this is a big deal to soybean traders, soybean watchers to watch this soybean market and where we go from here. If we look at all wheat production, 1.734, I was 23 million bushels too low on all winter wheat. I was right, essentially on the money with hard red winter wheat stocks, a little bit low. Soft red winter, 440 million, that would be a little bit high. And as we go to white wheat, 202. Other spring, 450. I was much closer there. And spring wheat lost it down to 5.5, excuse me, 55 million bushels there. And so that's something that we continue to bring some of these down, particularly those in the northern and the western part of the belt. If we look at yield, a crop 15.11 billion bushels on a yield of 175.1 bushels per acre, below the lowest trade guess. Okay, where did it come from? This is the state-by-state yields, and each yield is a 3-digit number, so pay attention to that. Don't pay the attention zero below it. That's because it's comparing it with March. And frankly, we haven't had a state-by-state yield estimate yet. Not from NASS that is published state by state, but this is data that we were able to pull today from NASS for August. I said that wrong. We have had it, we just didn't have it in July, so I couldn't compare it with July. So I went to pull from March, which March doesn't have any either, but this is August data. So you look, USDA putting Illinois at 201 bushels an acre, Iowa 203 bushels per acre. If we look at soybean yields, Illinois 62 bushels per acre, Iowa 58 bushels per acre. Those are some of the keys to watch. The darker colors are the highest yields, no surprise there. The core Midwest, largely where Pro Farmer is going to be touring. If you look at ending stocks, wheat going up to 615 million bushels with a $25 million bushel cut in exports is a big deal. That's bearish wheat. If we look at corn, 2.202 billion bushels, that's still a big deal. I'll look at how we got to that number. Soybeans at 245 million. That's keeping things up there at adequate levels, but still relatively tight. Let's take a look at more details. If we look at global ending stocks, pretty much right on where the trade expected, a little bit below where I was at. Corn, 311 million metric tons. I'm at 322.3. That number, I expect them to start coming down to me, particularly as they revamp their domestic balance sheet, which we thought would happen today, but hasn't. But we expect that to happen, USDA to come down toward our 322 number. Soybeans, 119.4. That's even lower than where I project right now. So that's getting tight. Concern, it's not a panic time for global supplies. U.S., yes, not global. If we look at the corn condition scores, we see that the corn condition scores are the lowest in Missouri. And if I look at the NDVI scores, they're below average in Iowa and in Missouri. Every other state of the major producing states is basically average or above average NDVI scores. So I think that says a lot about the greenness of the crop. And that's basically what's looked at with the subjective ratings we see here that come out each week, with our estimate being around 348 for our index number. USDA is coming in relatively hot right now. And so we'll see how this plays out, whether we see a drop in yield or not. The index right now is running about 348, which is very close to several other years where you can see where their yield ended up relative to trend. Below trend, near trend, a little above trend. So we're kind of hovering in here. So USDA coming in at 175.5 or 0.1 today. I put a trend and I use a 30-year trend yield, and it comes out to about 180.5 or so. So we're below trend now. USDA says trend is 181.5, a bushel higher than me. Some others I see use different trend formulations at around 177, 178, which would put us closer to trend. I found that the 30-year trend, and this is actually longer than 30 years here, so take that in mind, and it puts trend at about 180. But the bottom line is from here, depending on grain fill grain fill in August can add 10 to 15% to yield or take it away just by lengthening kernels by 10% or decreasing them by 10% under hot, dry conditions. So we're going to have a little bit of both of those conditions this month. If we look at export shipments, continue to sink. Now the seasonal line, this blue line, that's a seasonal weekly pace we need to be on to hit USDA's target. That has been coming down, 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 down each time USDA lowers its export target. But so have weekly exports been trending down, down, down as well. That's a real problem. Now, if we look at the balance sheet, here's USDA's 202 million bushels, 2.2 billion bushels. The numbers that are different, USDA has a bigger feed usage number than me. I'm trying to be more realistic based on animal numbers. I'm still up 125 million. I think that's a reasonable number. I actually think when USDA raised their feed usage number last month that they went too far. And I think after the September stocks report that they will come back down, but then lower their production estimate, which is what I have done right here. I'm 100 million lower than US on production, 100 million lower on feed usage as a result. Now, USDA is still 10 million higher than me on ethanol demand for corn. I think they're going to have to come down. As I figure it, we need to utilize about 480 million bushels of corn during August for ethanol production. And we haven't done that in a long time. That's difficult to do. So probably 10 to 15 million bushels off of USDA's target yet on ethanol. Exports for the current year, USDA did come down another 25 million bushels. That actually put them 5 million below where I am currently at. And frankly, I don't have a problem with their number based on what we're currently seeing. New crop then, this ending stocks estimate goes up here to be beginning stocks estimate 1.432. So I carry a little less corn in, about 25 million bushels less corn in than USDA. That's largely because USDA increased their imports to 35 million bushels very late in the marketing year. That kind of surprised me. That's a factor there as well. But anyway, you see my production number. We're using our 177 yield from our customer survey. So that's about 2 bushels per acre above USDA. That gives us about another 172 million bushels right there. My feed usage number is lower. My exports are much lower, but closer after USDA took 50 million bushels off of their export number. But they're still expecting this big, about 375 million bushel increase in exports in the coming year, when I'm going to show you our new crop sales on the books are really low compared to normal for this time of year. And prospects don't look to improve anytime soon. So my ending stocks estimate is 2.5 billion bushels. Nothing bullish about that. If we look at soybeans, again, the lowest ratings are in Missouri, and Iowa would be the primary factor, and also Michigan. If we look at where we're at relative to other years, not as many similar years there to look at. You kind of see where we're at. But the bottom line is we've been below the trend, the weekly trend. We need to be able to hit USDA's target now for about the last 3 months. That's making it real rough. And that's why I think that we're going to end up a little bit below USDA's export target. And I'll show you that in a little bit. Here we are. I'll show it now. So USDA has exports at 1.980 billion. I still have it there as well. But I think after the data from this week, and maybe I'll wait till next week, we'll see. But probably on Monday when I see export inspection data, I may pull that a little bit lower. What we don't have yet is Census Bureau export data for July and August. That's going to be a key as well. That lifts us a little bit above where inspections would. If we look at spring wheat condition scores, 319 nationally. That's below the 5-year average of 345. If we look at acres harvested projected this year, we see that winter wheat acres lost 205,000 acres. I was shocked not to see Kansas go down in this report. When we look at winter wheat yields, they went up 1.2 bushels. So a net loss overall. Spring wheat harvested, a net gain of 165,000 acres, net loss of 3.4 bushels. If you look at durum wheat acres harvested, up 190,000 due to an increase in planted acreage, and yield down 2.4 bushels. If we look at it by class, easily white wheat stocks remain the tightest. We're keeping an eye on that. Hard red winter wheat broke the downtrend and is now turning back up. Oh, that's not very good. Let me try that again. And they're up. Okay. But we're still seeing hard red spring trend lower. Soft red winter is doing what a hard red winter is doing. White wheat is kind of trending higher, and durum a little bit lower. That's why durum prices are so high, although they did break hard at one time this week, better than 50 cents. Okay, wheat, there's less mystery there. We're past it. My stocks are a little bit tighter than USDA has them. And I don't think we'll see this yield changing a lot from here. I'll be starting to look forward to the 24-25 marketing year here soon. So your take-home points today, and then we'll be taking questions. USDA's corn soybean yields are lower than expected, putting the focus on next month's field survey-based yields. Let me say that again. Putting the focus on next month's field survey-based yields. Got that out. This month, yields came from a farmer survey and satellite data. Next month, they'll do both of those again, but they'll add in their objective data of collecting samples from fields, weighing samples from fields. That'll increase the accuracy. Stocks still remain ample, though. No problem there. Weather is still the primary focus, but prices are going to remain susceptible to headline risk from the Black Sea and from the credit and banking sector. We don't know what days those headlines may hit. When they hit, they tend to be bearish. And that's going to be a risk you have to maintain in your marketing plan. So a quick promo of our Farm Advantage app, free for the download. Several apps within one app, including weather on your farm, local cash bids. My commentary is on there as well. Take a look at it. Go to farmadvantage.com, download it today. And with that, I'll say follow me on Twitter, direct message me there, come to stonex.com, follow me there. But with that, I'll open it up for questions and look forward to hearing what those questions are.
Hey, Arlan, can you hear me?
I can.
Fantastic. So we do have some questions here in the Q&A section. Feel free to enter your questions in there, and let's go ahead and get started. So this first one is, how can a USDA price for new crop soybeans be less than the old crop when the carryout is less?
It all comes to time of year, old crop, and demand. When we look, and I don't know if you're looking at the marketing year average cash price on the balance sheet I just showed you, but it also matters when the farmer sold. For example, for new crop soybeans, the fundamentals might say the price should be such and such, but if the farmer has been actively selling, pre-selling new crop ahead of harvest on some of the recent price rallies, that lifts next year's marketing year average cash price. So And if he doesn't sell, that can allow it to drop. We know that this last year, the old crop price, that they sold the rallies aggressively and got a higher price relative to where stocks ended up. So that's where you get that aberration of the marketing year average price relative to where we're at ending stocks. And I hope that answers the question, but it has to come with the timing of when the farmer sells, and that sales window goes well beyond when the marketing year starts, be it the farmer selling at a low price or a high price relative to what that marketing year's fundamentals would suggest.
Thanks, Arlan. Is there a risk of U.S. losing market share to Brazil as far as corn exports to China for good?
Not only is there a risk, it is happening. And your question there at the end is for good, and I believe that yes, that is true. Having said that, I believe that Brazil has more weather risk to their production than what we do in the Midwest. In other words, Mato Grosso can have wonderful weather or it can have horrible weather. And so you go back a couple of years and we had a pretty short crop there, a couple of years in a row, pretty short crop. And now all of a sudden we've really escalated the yields because we've had favorable weather down there. So you get big swings from good and bad that can leave the U.S. at play, but it's really hard to build a marketing plan and a cropping plan based on what might happen in Brazil weather-wise. But yeah, aside from that, with the cheaper currency exchange rate advantage, expect Brazil to take market share away from us. That is why it is important that we be focused on developing domestic demand and continuing to focus on expanding our export demand for countries who may want to do business with us, but especially at domestic demand. And that's going to be important. And I think we are probably more focused on that than what Brazil is.
Thank you, Arlan. This next question is, it seemed that spring wheat production surprised with a tight number. It was lower than the lowest market estimate. Couple this with apparent quality issues out of the Black Sea and EU. Do we think there could be a protein premium in the wheat market this year? And can you talk a little about the Minneapolis KC or Minneapolis Chicago spreads?
Yeah, I'm limited in what I can say about the spreads based on how we are created under Dodd-Frank regulations here in the United States. But I can say that we do see some indications that we could see tight milling quality wheat supplies in the world. We're seeing increased quality problems in Europe right now, and particularly in Germany. That's one of the areas where we get a lot of quality wheat going into the world market. So it is a concern. What's the size? We did see a downgrade in Canada's hard red spring crop. And as you said, indicated in the question, we've got some quality problems with lower proteins than what we'd like to see in the U.S. Northern Plains. So it is a concern going forward. Now, the hard red winter wheat crop here in the United States had a higher protein content than what we've seen in recent years. That helps with that problem. It comes back to the mills. Can they find what they need and adjust their mixes appropriately, or do they have to pay up for what they need? And I don't think that's been determined yet, with the North American harvest being what it is yet. But there is some risk of that we're going to be pretty snug on quality milling stocks with the desired protein. And so there is that risk of higher protein premiums.
Thanks, Arlan. We are getting a lot of questions here about FSA, so I'll try to combine some of these. Do you have any thoughts on today's FSA prevent plant numbers? And is there a rule of thumb for understanding the actual impact of these numbers on USDA acreage estimates?
Well, the FSA numbers are actual numbers of what farmers are doing, because farmers, to participate in government program, have to certify their acres with the FSA and tell them exactly what they've done, and they're subject to spot checks by USDA. So from that standpoint, they are the most accurate acreage numbers. That said, not every farmer participates in the program. That will vary from year to year. Yes, most do, but there's a 1 to 3% or so that do not. It will vary year to year. And so when we get the final FSA numbers in, USDA will adjust their acreage. They adjusted their wheat acreage this month based on FSA data. They will adjust their corn and soybean acreage in September based on the FSA data. And the FSA data won't be probably totally complete then. They'll probably fine tune it in October, and they'll make more adjustments likely then as well. And then to finally bring them all together, for the January report. So FSA does have a big influence on those final acreage numbers. We should get the biggest influence show up in next month's report. The general thinking is corn acres pull back a little bit, soybean acres go up a little bit. For those hoping that we'll get 4 million soybean acres, not likely. Probably less than 1 million acres, although that would be significant. And that's largely because that June 30th acreage report probably incentivized some more double cropping of soybeans. On the corn side, we'll probably see a little bit of pullback, but I don't think it will be a significant pullback that would really significantly impact the price structure.
Great. Thank you, Arlan. Let's see here. We are coming up on time, but wondering if maybe we've got time for one more question.
You bet.
Okay, here. Just scrolling through here. Your base case soybean and corn prices result in less than a 3.8 ratio. What does that mean for next year's acreage outlook?
Yeah, very observed on you, Eric. That's a good observation. And so as we look at that, what the market is currently trying to do, if that verifies, because we're not there yet, that's not our price ratio yet, would be to buy soybean acres at the expense of corn. And what I'm basically saying is that I think the soybean balance sheet is going to be tight enough over the next year to hold prices up relative to corn. And the corn market's going to try to discourage planting acreage next year or move farmers away from corn acreage. Now, let me give you the caveat on the soybean acreage. And I don't think I covered this today, although I have stated it previously. We believe that Chinese soybean imports, largely from Brazil, from May through September, so that's what they've already imported, and what the bookings and loadings are on the schedule for through September, will amount to a surplus of soybeans coming in above crush of about 12 million metric tons over that period of time. So if you look at soybean stocks at the ports where the crushing plants largely are, those supplies have been staying right around 7 million metric tons. So the surplus soybeans must be being trucked to reserve facilities. A year ago, last winter, they pulled soybeans out of reserve back into the crush demand sector. So to reduce the amount of soybeans they need to buy from us. Will they do that again to a greater extent this year? We don't know. If they do, my export target is currently 50 million bushels than today's USDA new crop export target. It could be a lot lower than that. If they don't, it could be a little higher. I feel real good about my number now, even if they don't do that. But if they do that, we've got a lot more weakness, and we'll see new crop fundamentals kind of crumble on us and the price opportunity as well. We should know that by time we get into the heart of harvest. We should know that a lot better, and USDA will probably start reflecting that in their October WASDE report. But that's going to be a key to watch for the soybean market. I'm bearish corn. I'm not bearish soybeans at all until I see what USDA is going to, what China is going to do on that question. So that's the answer. And with that, we thank you everybody for being here. If you were unable to get your question answered today, feel free to reach out to me and direct message me on Twitter, and I try to respond to all the questions that I get there. Thank you for coming back to be with us this month. We look forward to seeing you next month as we get more yield adjustments and see what USDA does. Thank you again. Be careful out there with this year's harvest.
Thanks, everyone.